Good evening, everyone. An ugly day for stocks on Wall Street and all around the world. The Dow tumbled more than 300 points, but stocks in Europe, Asia, and Latin America were down between 2 to 3%. Argentina, the biggest loser, plunging 4%. Now, the worry started yesterday, as we reported, on concerns about a slowdown in China's economy. Those worries spread to Latin America and other emerging countries that are big trading partners with China. Add to that lackluster earnings news from corporate America, and you get the picture. The Dow fell 318 points, the Nasdaq down 90, and the S&P lost 38 points. Bob Pisani has more on today's market action from the New York Stock Exchange.
It was another tough day for the markets. The second day there's been concerns over emerging markets, but it's really a concern about China. There's lots of reasons why traders don't like China, but the main problem is that it's a bit of a black box. Not only is there economic uncertainty, there's a lack of transparency. There's just not much information coming out of the country, and investors aren't sure they can trust the numbers. These issues have been around for a very long time, but recently there's been some signs of economic weakness and also a credit crunch. So investors have been getting nervous and pulling back. In the U.S., there was red right across the board, but the biggest declines came in industrials and materials. Those are two sectors that are very exposed to emerging markets. Now, two groups that have been strong all year reversed today. The Dow transports were down over 4%. That's the worst showing in 9 months. And the small cap Russell 2000 dropped almost 3%. The yield on the 10-year Treasury dropped below 2.75%. That's the lowest level in 2 months. Gold also rallied to its highest level in 2 months. Now, for the week, the Dow is down nearly 4%. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So why is stress in smallish or even tiny foreign economies and in their currency and stock markets having such a negative impact on Wall Street and on your portfolio? Sarah Eisen explains.
They were the bright spots. They even had a catchy name, the BRICS, that became a shorthand for the fast-growing emerging markets that helped lift the world from the depths of the financial crisis.
China,
the Ukraine,
Argentina,
Brazil.
Investors are heading for the door in these emerging markets right now because of mounting economic and political tensions in countries like Turkey and Argentina, uncertainty in Russia and South Africa, and worries about China's super fast growth slowing down. The big worry is that problems in these individual countries could escalate into a bigger crisis.
When it's one country specific, it's like credit.
Yeah.
It's like if it's name specific and we're at that part of the world, how's this country doing, that country doing it? But at some point, it becomes kind of a macro event.
It's not yet.
When all these countries that are very far apart on a globe are very, very close together in investors' minds.
And these countries are starting to look worse to investors now that the Federal Reserve is in tapering mode, scaling back some of its massive stimulus, that giant flood of money that has masked some of the world's problems. The big fear is that a currency crisis could spin into a major economic and financial crisis. Think 1997. A steep slide in Thailand's currency, the baht, triggered a full-blown Asian crisis, causing economic pain in the United States as well.
I think there's a balancing test going on right now between the strength in the United States and a little bit of a slowdown in the EM. My guess is that this is not the correction that people are expecting, and primarily because we're still in dramatic QE.
Whether it will spark a full-blown crisis or not, economists are getting more gloomy on prospects for economic growth in the developing world. And instead, it's the United States now that the world is looking to be the engine of global growth. For Nightly Business Report, I'm Sarah Eisen.
Joining us now to talk more about the big global sell-off, David Gordon. He's chairman and head of research at the Eurasia Group. Also with us, Mark Lucchini, chief investment officer with Janney Montgomery Scott. And gentlemen, thank you both for joining us to discuss this big issue. David, let me begin with you. You heard our reports, China, China, China. Everybody is saying that that's what got it started, but you don't see it that way. Tell us what you think is the catalyst for this big sell-off.
Yeah, so I think that a little bit of this is bad news in China, but I think a lot of this was mounting concern in Argentina, a deteriorating political and economic situation in Turkey, huge unrest in Thailand, increasing instability in Venezuela. So I think a lot of this, the worst cases here are quite country specific. And even on China, I think to the extent that China was the spark in the last 36 hours, I think it's overstated. I don't see the kind of severe downturn that I think some people in the markets are pricing in. A lot of this, frankly, is Davos yesterday, where there were these hostile issues around China, Japan, and I think there's a lot of groupthink, negative groupthink, and huge numbers of big players in international markets are in Davos. I think that a lot of this is a negative Davos effect.
That's a very interesting point. Mark, do you see it that way? I mean, David focuses on political uncertainties, instability in some key players. Do you see it that way, or do you see it more a sort of reverberation of a slowing Chinese economy with its strong appetite for commodities affecting some of those countries that are, in many cases, though not necessarily Turkey's case, commodity-driven?
Tyler, I think it's more the latter than the former. We know that China has been deliberately attempting to engineer a slowdown in its economy. It just happened to be in the context of global economic activity slowing over the last couple of years until recent. And as a consequence, it has already had a backlash effect on so many other emerging market countries that are today much more reliant on exporting amongst themselves, and particularly to China, than so to exporting to markets like Europe and the United States. Within that context, though, certainly some countries have specific issues, some of which were named previously by the other guests, but I don't think individually those countries are necessarily the cause for concern. This emerging market story is not new. I mean, there's a reason why last year in 2013, where you had the S&P up 32%, the EFI up 25%, and the emerging market index down 3%, that was already signaling problems in the emerging market area. I think what we basically are seeing is, after basically 2 to 3 months of economic surprises that kept mounting on each other. If you look at the Citigroup Economic Surprise Index, it's gone parabolic since November of last year, met the intersection of rich valuations, and that combination took less than perfect news to trigger the most anticipated correction that anybody's seen in about 27 months.
So, David, you just talked a moment ago about a negative Davos think. Let's bring it forward to next week and see what you think the Fed think is going to be, because a number of people have been speculating that maybe Federal Reserve policymakers looking at this big sell-off may dial back on their plans to taper back on these stimulus measures. What do you think?
You know, I think the Fed still overwhelmingly will base their decision on the dynamics internal to the U.S. economy. But I think if you do have this continuing market volatility, that will definitely have a negative impact domestically. So I very much do think we could see a little more caution on the part of the Fed policymakers, yes.
All right, quick thought, Mark. Should I get out of emerging markets right now and just let this blow over? Got about 25 seconds.
I think real quickly, emerging markets as a basket, yes. We are not constructive on emerging markets overall. We think it's going to be a much more nuanced story on a go-forward basis. We like Vietnam, we like Mexico, we like developing Europe, i.e. Poland. But in the aggregate, to hold emerging market equities, we think there could be more pain yet still to come.
All right, Mark, David, thank you both so much. We really appreciate it. Have a good weekend.